Hello and welcome back to All Things Money. I'm David Blain and thank you for joining us today. We've got a great show going here. We're talking a little bit about some of the immutable laws of investing. If you missed the last segment, I think it is a very, very instructive segment. You can go to the website, www.dlblain.com, and in a week or two we'll have an archived copy of it up there for you to listen to or watch. But the gist of the last segment was I went through and I read an article from August of 2000 from Fortune magazine where they laid out the 10 stocks that were going to make you wealthy over the next decade. I mean, these were the must-own, the leaders in their industry. And the gist of the story, well, this wasn't in the story, but if you go back today and look back, what happened to these companies over the next 10 years is that if you invested $100 in these companies, it would be worth about $30 today, and several of the companies are out of business. And the point of this is that all these companies were trading at very high PE. Basically, the PE is a multiple of earnings. It's the price. The P stands for price, the E stands for earnings, and it's the price divided by earnings, and it comes out to be a number. The average for the stock market as a whole, somewhere around 12 to 15 has been the historical average. Basically what that means is that investors are willing to look out 12 to 15 years and pay for earnings 12 to 15 years from now into the future. So if a company is earning, say, $1 per share and its price is $10 and its earnings are $1, its PE would be 10. If its price was 20 and its earnings were $1, its PE would be 20. So if you pay $20, it's going to take you 20 years for that company, if it continues on the same path, to earn $20, the price of the stock that you paid. So investors use the PE to gauge whether a stock is expensive or cheap. You go to the grocery store and a loaf of bread, it says, $5 on it. Well, last week if it was $4 or $3, you can tell, well, is it worth $5 for me to have a loaf of bread? And so you can kind of judge whether that loaf of bread is cheap or expensive. Well, the PE is designed to do the same thing. It's certainly not 100% accurate, and you shouldn't rely on it completely, but it's a pretty good gauge of whether a company, either a stock or an entire stock market, is cheap or expensive, is whether the PE is low or high. And of course, maybe low or high compared to its earning growth, maybe low or high compared to other countries, to other stocks. So you have to put it in, put it in perspective to something. But we use the PE as a gauge. And so it goes to the first rule of investing is always invest with some sort of margin of safety. And that's when this article was written in Fortune magazine in August of 2000, these companies, they had no margin of safety, that they were priced at such a high PE that if anything at all went wrong with the growth story of the company, such as Enron, you stood a good chance of losing all your money. And in Enron's case, you did. A lot of the other companies, they were priced, if you had a company that was earning $1 and you paid $100 for it, you paid 100 times earnings. That means that company would have to have an astronomical growth rate for you to recoup your $100 investment at any point in the future through either dividends or capital appreciation. And so the first thing is always insist on a margin of safety. One method of doing that is looking at the price to earnings ratio when it comes to stocks. There are other things. You can look at things like book value. You can look at things like price to sales. One of the big things you don't want to look at back in the internet bubble was, I don't know if you remember, the number of eyeballs that people were selling stocks based on the number of eyeballs, people that were looking at the website. That's just not a smart way to invest, is based on the number of eyeballs looking at a website. I think there was like Web Grocer or something. Everybody was looking at it to see what what it was all about, but nobody was buying their groceries and they were making no money. They were losing a lot of money. So we don't recommend number of eyeballs as a margin of safety. Now, when you're investing in the bond market too, we want to look at things. There are margins of safety for the bond market too. For example, if you look at the U.S. Treasuries today and the yields that they offer. Remember, with bonds, as yields go down, prices go up. If yields go up, the price of bonds go down. And so there is a margin of safety in bonds. With U.S. Treasury, there's very low risk of permanent loss of capital. A couple of years ago, I would have said there's no risk of permanent loss of capital, but unfortunately, with the way that our country's monetary and fiscal policies are going, I'm not sure that I'm willing to say that anymore. But it's certainly the U.S. Treasuries are still one of the more highly rated securities out there today. In crisis times, people still seem to go to the U.S. Treasury. So there is some margin of safety when it comes to absolute risk of capital, whereas if you go and invest in, say, Zimbabwe government-issued bonds, there's huge risk of loss of capital. And so you would want a huge margin of safety, meaning that, you wouldn't want to pay more than a few cents on the dollar for bonds of Zimbabwe. In fact, I wouldn't buy Zimbabwe bonds at all, but you get the point of the example, is that you have credit risk. You have, companies in the bond market like, say, maybe a GE, which now has the implicit backing of the U.S. government, sort of too big to fail almost, or a brand new startup company that's out there looking for capital. Well, the margin of safety there is the interest rate. You know that this company is possibly more risky than this company, and so you demand as an investor a larger interest rate. You would have no margin of safety if you were willing to accept the same interest rate for a brand new startup company as you were a mature company such as GE or Coca-Cola or something like that. So that's rule number one, is always insist on a margin of safety, whether it's a stock, a bond, real estate, whatever type of investing that you do, you want some sort of margin of safety, meaning that if you're wrong about the investment, that it's not the next Microsoft, or it goes out of business, that your permanent impairment of capital is not that great. So we'll continue with some of these laws of investing next week. We hope that you will join us on Cable TV 10 and WNBU. So for All Things Money, my name is David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.